Ladies and gentlemen, good day and welcome to the Q3 and 9 months FY21 earnings conference call of Pennar Industries Limited, hosted by PhillipCapital India Private Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Mr. Vikram Suryavanshi from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Margaret. Good morning and very warm welcome to everyone. Thank you for being on the call of Pennar Industries Limited. We are happy to have with us management of Pennar Industries here today for question and answer session with investment community. The management is represented by Mr. Aditya Rao, Vice Chairman and Managing Director, Mr. Shrikant Bakkar, VP Finance, Mr. J. Krishna Prasad, CFO, Mr. Manoj, Head Corporate Affairs, and K.M. Sunil. Before we get started with the question and answer session, we will have some opening comments from the management. Over to you, sir.
Thank you, Vikram. This is Aditya, and I wish a good morning to all the stakeholders of Pennar Industries. And I thank you for attending the third quarter for the financial year 2021 conference call. I hope all of you are safe and are taking all necessary precautions during this pandemic. The structure of the conference call will be the following. I will first provide an overview and my comments on the third quarter performance. Our CFO will then provide details on major financial metrics. Post this initial summary, we will take calls from our stakeholders. Firstly, we will start with an overview of performance. Quarter 3 saw further improvement in our revenue compared to Quarter 2 of the current fiscal. We recorded net sales of 412 crores in Q3 compared to 390 crores in Q2. In Q2, we had recorded a marginal profit as we recovered from the lockdown that was imposed and the attendant issues with the addressable market. We have substantially grown our profitability in this quarter with a net PBT of around 3.42 crores and a cash profit of 16.17 crores. As mentioned in the previous conference calls, our updates going forward on our investor conference calls will be broken into 3 parts: profitability, liquidity, and growth. On profitability, we have re-achieved profitability at Pennar, and our focus is now on re-achieving our pre-pandemic profitability and cash profit. Post that, our goal will be to start generating growth quarter on quarter compared to the pre-pandemic quarters. We are now confident in projecting that in Quarter 4, we will re-achieve our pre-pandemic PBT, PAT, and cash PAT on a monthly and on a quarterly basis. Coming to liquidity, we are also hard at work to bring down our working capital usage in terms of number of days of revenue. We had discussed reaching working capital usage of about 420 crores while growing revenue on our last call, and I'm happy to note that we have achieved this. We have at 421 crores. We continue to work on revenue growth, and we will re-achieve our pre-pandemic revenue in this quarter. However, we continue to work on reduction of working capital usage in terms of number of days. So our current target is to get to 75 days cash-to-cash cycle. We are currently at around 100 days on that. Through reduction in accounts receivable, inventories, and as well as working with our vendors and suppliers, we intend to achieve a cash-to-cash cycle of 75 days by the end of the first quarter of the next financial year. Coming to growth, we have continued to invest in our growth opportunities in the third quarter, specifically our DIW plant in Chennai, our ICD capacity expansions in Chennai, our metal buildings plant in Tennessee in the US, and our tubes IOR sales in the US. All of these investments will bear fruit in the current quarter and in Q1 of the next financial year, and we believe that they will allow us to substantially grow our PBT, PAT, and cash PAT. We expect to commission capex of around 75 crores in this financial year, as we had mentioned on our last call. Our current addressable markets also continue to show a lot of recovery. Most of our revenue streams will have returned to their pre-pandemic status in this quarter, which is the fourth quarter, with the exception of our PEPs, railways, and environment revenue streams. The railway vertical's outlook is currently unclear, and I should be able to give a better idea of the way forward for this in the next quarter. PEPs and our environment vertical will return to pre-pandemic profitability in Q1 of the next financial year. As I mentioned the last time, we believe that the combination of these two initiatives, recapturing our addressable markets over the next few months and investments into new addressable markets, will allow us to exceed our pre-pandemic monthly revenue and profitability before Q1 of the next financial year, and we are well on track to achieve that. We do not give guidance, but what we had started over the last 2 quarters is to give a broad idea of where we are headed for the current quarter. In that, we would like to note that in Q3, we had achieved 70% of our pre-pandemic cash PAT. Pre-pandemic cash PAT being defined as the PAT plus depreciation plus any deferred tax in Q3, because Q4 onwards, obviously the pandemic had started, the lockdowns had already been initiated. So we generated around 16.1 crores of cash in Q3 before tax, and the corresponding Q3 for the previous financial year was around 23 crores. At this point, the management would like to state that we are likely to achieve 100% of our pre-pandemic PBT, PAT and cash PAT very soon. The reference quarter we're using, as I had mentioned, is the third quarter of the financial year 2020. As from the fourth quarter onwards, the pandemic and the lockdown in India had commenced. In conclusion, I would like to reiterate that what we had committed on our last call, that we are confident that we are well placed to regain our profitability levels, improve our working capital, and ensure growth in the next financial year is well on track. On that note, I will hand the call over to our financial controllers, Mr. Srikanth and Mr. Krishna Prasad, for their brief on the third quarter performance.
Good morning to all the stakeholders. The consolidated financial highlights for the Q3 FY 2021. The net revenue, we were at 412 crores compared to net revenue of 390 crores in Q2. That is up by close to 5.5%. In terms of EBITDA, we are at 37.53 crores in the current quarter versus 32.67 in the Q2 of FY 21, which is up by close to around 15% from the last quarter. PAT after the minority interest is 2.57 compared to PAT after the minority interest at 0.24. So even if the increase in the revenue of net percent of 5%, but overall the PAT has increased by close to around 10 times. In terms of consolidated financial highlights for the 9 months, it is net revenue wise we are at 968 crores versus 1655 the last 9 months. In terms of EBITDA, we are at 57 crores versus 158 crores. Overall, in terms of the highlights, the SN Building LLC, which we have as a wholly owned subsidiary of Pennar Global Inc., would invest close to $4.9 million for setting up a PEB plant in USA. This we have briefed in the last quarter that we are setting up the subsidiary. Now we have decided to invest, and the total investment would be $4.9 million. Pennar Industries has a healthy order book position through this quarter, and the order book position as on 31st of Jan, 1st of February is Petra has a close to around 434 crores in terms of order book. Enviro division has 46 crores and Railway division has 200 crores. So these are the broad business highlights in terms of the financial performance. Now I have handed over to the moderator for the question answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, you may press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who would like to ask a question, please press star and 1. The first question is from the line of Dilip Sahu, an individual investor. Please go ahead.
Yeah, hi, Aditya, good morning. My question is regarding the asset investment. What would be the asset turn in this business and profitability? And as per your press release, you will get into production, commercial production by first quarter of next year. which looks like a very, very short time for from getting into the project to getting to production. So can you just throw some light on this? That's question number one. Question number two, we had some big write-offs of bad debts in last 2 years. Is it over, or is there something pending, or what kind of write-offs we are looking in this year and next? That's the second question. And the third question is, obvious question is about the cost of raw material, and we have got a huge building, prefabricated building order book. How is the current rise in steel prices going to impact both building and railways order book?
Thank you. I will answer the questions one by one. So, SN Building Systems is a step-down wholly owned subsidiary of PGI, which is a wholly owned subsidiary of Pennar Industries. The asset turns that you speak of, the total capital we will be deploying is about $4.9 million in that company, and we expect a first-year revenue internally of a certain number. But what the CEO of that business, who's a veteran in that field in the US, has committed to us, and what we have already started generating an order book, gives us the ability to say that we are expecting around 15 million. So an asset flip of about times 4 is what I would guide you to. But do keep in mind that I consider this to be a conservative estimate. I believe we will be able to improve substantially on this, but at a minimum 4 in terms of revenue flip. In terms of commissioning of the plant, the question you had was that it's a fast turnover. There are a couple of reasons for that. One is that we bought the building, which is the factory building, which it was previously a metal building plant which was not being used. So we have bought that. So we did not need to make the building or do the civil works. What we needed to do was to install the equipment and make sure that all the attendant required equipment in terms of material handling, cranes, movement were all installed. So that has resulted in the total capex, and also that the plant gets commissioned very, very quickly. So as you said, as you had said, in fact, also that we expect the commissioning of this plant to be in the first quarter of the financial year, and we already have an order book of close to about 4 to 5 million on this. We have a very good team over there. They're very enthused about getting up and running, and I think we are quite comfortable saying that this business is going to start contributing to our revenue and profitability well in the next financial year itself. The next question you had was on write-offs. By write-offs we mean that if there's any accounts receivable which is not collectible, or if there's any inventory or current asset which is either a obsolescence for that current asset or any other kind of write-off. At this point, we don't expect anything specific. We constantly measure the quality of our current assets, and we don't currently have any concerns on that. These are independently assessed externally. So nothing to share on that point that there will be any massive. However, we do constantly provision quarter on quarter for a certain percentage. Consider it a historical assessment of illiquidity in accounts receivable or inventory. So we provision for that. So we'll continue to make provisions, but that's obviously not the same thing as write-offs. As of right now, I have no substantial write-offs which would be material to the company to communicate at this point. The last question you had was on steel prices and the cost of raw materials impact on our order books in PEB and in railways. We have made sure that any steel price increase, and it's been pretty massive as you have noted, 70% in the last 3 to 4 months. We have ensured that margins are protected. We did have an issue in the third quarter where some of the revenue we had to go back on because of the rapid steel price increase predicated that we were not able to cover the raw material. I can assure you any order that is booked at a price, we try to cover the raw material cost through our relationships with JSW and Tatas and other steel providers. If for whatever reason that is not possible, we will give up that order book. As of right now, the order book for both PEBs, for Enviro and our railways business are at our standard margins. There is no difference. Wherever, for any orders where we've not been able to cover, we've gone back to our customers and asked for a price negotiation or a price variance clause. So all of that has been done. So at this point, we have no order book right now, or our average order book margins contributions, which we monitor every month, have not decreased by any measure compared to the previous quarters. Does that answer your question, sir?
Yeah. Can I ask one more question, or shall I come back on the queue?
You can go ahead, sir, since we have.
Yeah. So I was listening to the Tube's investment con call, where they talked about certain concern in the railways business in terms of execution because of COVID, and also the uncertainty regarding order book. So do railways is a profitable business for us and it's fairly substantial in terms of order book. So what is your comment on railways in general for next 2 to 3 quarters?
I would share the concerns expressed by TI on railways. While we currently have a reasonably strong order book, and yes, railways as a business unit is still profitable and has good profit margins, we are unable right now to give you clarity on what's going to happen in the next 1 quarter also, because there is a dramatic drop in offtake from our major railways customers, which include ICF, which include MCF, and others as well. So at this point, we are not able to comment more than saying that it will continue to be a profitable vertical. However, to give you a really clear picture of what we expect for the next financial year, we will have to wait. I will probably have to give you that clarity, because right now we do not possess that clarity. It could go in a couple of different directions. So I think the most proper course of action is for us to withhold comment on that from our side until there's clarity for us, so then we can communicate that clarity to you. Of course, I would like to state that all of the comments we had made in terms of our profitability, what we're going to achieve in this quarter, specifically re-achieving our pre-pandemic profitability in terms of PBT and cash PAT, we will absolutely, we have taken that into account, taken the current railways situation into account before committing that. And we are quite confident of the commitments we have made on the call today. But yeah, railways right now, I am unable to give you clarity. I share the concerns that TI would have mentioned on their call. It's very, very vague right now.
Yeah, thank you very much, Aditya, and all the best for next quarter.
Thank you, sir.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Vijay Kumar, an individual investor. Please go ahead.
Hello, you're able to hear me?
Yes, Sam. Go ahead, Vijay.
Hi, good morning. Thank you for taking my question. I would like to get some comments about your outlook on interest cost. We have been always guiding towards 3 to 3.5% of turnover, especially when most of them are current assets. But for the lockdown period, we think we were not able to see that proportional at 3.5%. Now we are almost crossing 5%. So where are we headed? Is there any balance sheet actions? How are we planning to get this debt in control, interest payment in control? Can you throw some light, please?
Thank you for a good question, Vijay. Important question. Srikanth will answer this question.
Vijay, we are taking multiple steps here in order to reduce the working capital usage, which is a little high. And as we said at the beginning of the call, presently the working capital is close to 100 days. And whatever the receivables that we have and the inventory that we have reviewing each inventory and the debtors part of it, line by line, to see that we can collect more in terms of receivables. And wherever there are non-moving inventories and non-receivables, we are making those provisions as well in the books. The interest cost is presently high because of certain pre-pandemic, whatever the debtors that we have are still going to complete. And there are a lot of sites which are stuck at where the monies are stuck. So those are retention monies which we have typically in the projects in terms of PEB and Pennar and Enviro. So as and when those monies come back and flow back into the company, this cost will reduce. You are right. We have challenges here in terms of overall interest cost being higher, but we are making sure that interest cost reduces as and when our addressable market and the revenue grows. This is also because the net interest to net sales percentage is also presently high because of the lower net sales cost. While the debt has also reduced, it is not significantly reduced in terms of what we have. The finance cost is reduced close to around 5.5-6%, while the revenue overall has reduced by 40% when you compare period on period. So these are the differences why we have, as we increase our revenue, we would not again have the additional finance cost which will come back. Though we will have the working capital movement, we will not have that kind of again increase. So your question is right. We have presently a little high interest to net sales percentage, and then we will ensure that this comes down. Give us couple of more quarters, I guess, and I think we will be fine.
You will to add on to that, Vijayji, I think you will see the 5% come back down to 3% in the next couple of quarters, as Srikanth has said, and you will see substantial improvement in the next quarter, in the fourth quarter itself. But the challenge has been the higher working capital we are carrying in terms of number of days is directly resulting in a higher interest cost. Also, when a lot of the newer revenue streams, when they get commissioned as well, and they are also at a working capital which is in line with our, as I said, our cash to cash cycle, that too tends to moderate the entire our entire working capital, and under correspondingly it's our interest cost as a percentage of net sales. So we expect by this 5% to improve dramatically over the next couple of quarters, and in fact in this quarter itself.
Thank you and good luck.
Thank you. The next question from the line of Venkat Subramanian from Organic Capital. Please go ahead.
Hi, thanks for taking my question. In the minutes of our board meeting, we seem to have taken an approval to actually put one of our businesses on low priority and probably actually exit. Can you throw some light in terms of what the thinking is here?
We're not actually exiting any business, sir. Are you referring to the OneWorks sale, sir?
I probably got a sense that it's one of our BPO engineering design kind of business.
Yeah,
there was some brief mention.
So OneWorks was a company we acquired in the last in the financial year 2020. They are in the field of BIM, which is building information modeling. We have managed, even through the pandemic time, to scale that revenue up. But what we have done is transferred the customers, the contacts that we had from that business to the regular company. And since we have done that, it doesn't make sense for us to continue operating the wholly owned subsidiary because there's no all the revenue has now been booked in Pennar Industries. So it doesn't make any sense for us to continue to operate a subsidiary with no revenue. So BIM revenue now exists in Pennar Industries.
That's a very scalable business, right? I mean, that's something that we can probably grow manyfold from here, right?
Absolutely. So we are not exiting that business at all. We expect to grow that business further, but that will be on the back of organic growth now, or even if it's inorganic, it will be through other entities. What you're mentioning in terms of us exiting is there is a company which we acquired, which is a wholly owned sub. We have transferred the business to the main company. Now we would like to there is no point operating a separate business. There's governance, there's other issues. So it's a no revenue, no operations company, which we would like to put.
Understood. I would like to take you back to something that we discussed maybe about a couple of quarters ago, which was on the large write-off that we took about 12 months ago. And you said you didn't agree with your auditors and that there could be substantial recoveries, but we haven't seen that. Are we overestimating where do we stand on both the inventory and receivables?
Could you repeat the last part of your question, sir? You said a large write-off about a couple of years ago, and what did you say after that?
Not even a couple of years ago. I think it was last year, and we said that was something that you probably had to do because the auditors actually opined another in a certain way, which was and you are more confident about the recoverability of all that, but we haven't seen that, right? That has not played out, right?
So the asset, what you may be talking about, may be our HDO related NPCIL-related revenue streams. Those remain active as of right now, and we have a pretty strong accounts receivable. So whatever corrections were taken at that point of time, once those amounts are collected and the projects are closed, we will be able to get that back onto the balance sheet. And we still expect that to happen. However, because of the pandemic period, there's been a lot of slowdown in these projects, in these, shall we say, the projects which are from NPCIL and others as well. So once those come in, we'll be able to take them. But as of right now, the AR for that, I wouldn't call it write-off, all is provisioning in that. We still retain the ability, and we are very confident that we will be collecting that amount. There is no write-off, a heavy write-off that we are anticipating in our current accounts receivable or in our inventory.
Without going into specifics, I think if you go beyond the current quarter, what kind of visibility do we have? For instance, a lot of other engineering companies are talking about possibly the China plus one factor actually playing out. We are probably seeing a lot of activity on the ground. Doesn't that augur very well for our building solutions? And what kind of what's your outlook on the next couple of years?
I think China plus one has resulted in some revenue growth for us, especially in our industrial components division, and I think that will persist. I think there's definitely a groundswell of opportunity there, which we are absolutely trying to improve and grow on. In fact, our entire BIW investments can be thought of as an extension of resulting because of the current situation. However, when we make capital investments, we will keep in mind the long-term future of any business and not any short or medium-term imperatives that may drive it. Now, a lot of people feel this is something that's permanent, and I would agree with them also in some sense. But the capital investments we are making and our current assets, our current revenue-generating assets and our businesses are well placed to weather and to grow over the next 10 years. So we don't invest in any business unless we feel that business will exist 10 years from now. So short-term, medium-term investments, no matter how attractive it may look on paper, we are not going to be making. So consequently, if you look at our current revenue streams, which include our automotive fields, our railways fields, our building, pre-engineered building construction fields, and our environment fields, we believe people will need water treatment 10 years from now. We believe people will make buildings 10 years from now. We believe that people will drive. There will be an powerful auto sector 10 years from now, which it will move to electric, but that's the reason why we are also moving to electric in our new investments. And there will be a rail sector as well. So the last thing I would add is on the energy front, on solar as well. We believe solar is here to stay. Previously were only in the field of solar MMS, so we were not quite happy with what that field was achieving. But with our current value proposition, with our current revenue generating assets, solar also will continue to be big opportunities for us. So on all of these 5 verticals, automotive, railways, building construction, environment and energy, we are very confident that we will have good addressable markets over the next, I can't say over the next 6 months, 1 year, that will definitely grow because we're coming off such a low base in the last year because of the pandemic and the lockdown and the effect that has had on our addressable markets. But we are quite confident that the investments we have and the investments we have made, the assets we have and what we're going to procure are going to put us in a good place to improve our addressable markets. And if our addressable markets increase, our revenue and profitability will also increase. So we're quite confident. I mean, Q1 was bad, Q2 was profitable, Q3 more higher profit, Q4 absolutely substantially much higher profit. And next year, of course, with all of our assets coming online and hopefully some resolution of the pandemic and lockdown, we currently are very, very optimistic. We would project a very good year next year. And that story should continue as we continue on our growth path.
Understood, Aditya. All the best. Thanks.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Pranay Javeri from J&J Holdings. Please go ahead.
Good afternoon, sir. Thank you for this opportunity. I just have one question in terms of our order book, which according to the slide is about 680 crores, and in which, as per your statement, you are seeing some dip or some delay in the railway part. So, if I just look, it's about 30-35 day order book kind of a number. So, can you just throw some light on this, and how do you look going forward?
So the order book of 600 crores that I mentioned does indeed include our railways business, our PEB, Enviro and railways. And you are right in that, as I said on answer to a previous question, railways revenue is volatile. It is not zero, it's volatile. It's somewhere between 30-40% of what it was pre-pandemic. That being said, order books represent only about 40% of our revenue. A lot of our revenue is scheduled revenue. A lot of our revenue is, for example, for the automotive sector. We make a lot of automotive components. They're scheduled orders. We don't function an order book on that. Order book specifically affects or is active only in the PEPs environment and the railways business. Consequently, we don't believe that this railways reduction in any way affects our revenue, and it is not, as you had said, 35 days. In fact, in most of our verticals which are order book based, for example, PEBs having 434 crores of an order book right now, we have foreseeability for the next 10 months. For Enviro business, we have foreseeability for the next 4 or 5 months. Railways business, we have a large order book, but we don't expect that to translate to revenue at the same clip that it has historically been. So the issues that are outlined in railways, firstly, will not, we have taken that into account when we are projecting revenue growth for fourth quarter and very substantial profit growth for the fourth quarter. See, since the majority of our revenue is scheduled orders and not order book based, the entire order book and that being taken as 35-40 days would give you an inaccurate picture of our revenue foreseeability and revenue safety nets right now.
What would FY22 look like in terms of top line, if you can just guide us, and on the EBITDA margin?
I can assure you it will be much higher than FY21. Beyond that, we have completed a budgeting exercise. The board has to sign off on that budget. Once that is done, I will definitely come back with a far more accurate idea. But at this point, I guess you can say it's going to be much higher than FY21. But what I can say is quarter-on-quarter growth will continue. That I can. So Q4 was, as I said, Q2 was better than Q1, obviously. Q3 was better than Q2. Q4 is better than Q3 substantially. And Q1 will also be better than Q4. That we can more or less comment.
Thank you, sir.
Thank you, sir. Thank you.
Thank you. The next question is from the line of Vikram Suryavanshi from Phillip Capital. Please go ahead.
Yeah, good afternoon, sir. Basically, can you give some more details about the tube business in terms of where we are in capacity utilization or compared to the pandemic, where we have reached in terms of revenue? And for tubes within that, how is the breakup for ERW and CDW, as well as the opportunities in export? So just more clarity on tubes business.
Understood, sir. So the tubes vertical currently executes about 20 crores in net sales per month. The majority of that is ERW. The CDW sales would be about 6 to 7 crores. From a pure capacity utilization point of view, our ERW plants are at capacity. CDW, we are at increasing our capacity utilization, especially with our tubes IOR revenue streams in the US increasing, which we will supply partially, if not entirely, from here, from India. So right now, our capacity utilization in tubes is close to, as a blended capacity, it's about 60%. But if you look to only at CDW, it's probably closer to 50%. So we will try to bring that up over the next few quarters. And as you are, I'm sure, aware, CDW is a more profitable vertical. So that's good news from a revenue and profit growth point of view that we are looking at higher sales. In fact, in the last month itself, we have improved our exports of CDW substantially from from selling about $200,000 per month. We are now upgraded to 300,000. We expect we will reach about 600,000, about 4 to 5 crores per month. So exports itself reaches that plus the domestic market combined should take our tubes business's revenue and profitability up higher. But we are quite optimistic that tubes will do well in this quarter and going forward.
And in future, will we look at the opportunities from tubes to go to the higher size, like pipes and all that in metals, or tubes will be big opportunity for us?
We have a large diameter project. We had kept it on hold considering the pandemic. We are in discussions with the business unit head of that vertical, and I will get back to you on when we will. But we do have plans to do that, and at some point of time we have to do it. Now, is that in this current fiscal? No, we will not be commissioning that capex or investing capital in that. Whether we're doing it next year or not, I'll come back to you once we have completed our internal discussions.
Okay. And as a bookkeeping question, what is current gross debt and cash level on the balance sheet? And second, the 75 crore tax for this year, but now we are seeing revenue is picking up to almost a pre-pandemic level, and growth is coming back for almost all the segment. Are there capex plan finalized for the next year, or will the large part of basically want to understand that the free cash flow, will it be invested again in growth, or how is the plan for the deleveraging?
Regarding the debt, I will hand over to Srikanth and KP Garu for their comments, and I will answer the capex question after that.
Yeah. In terms of the total debt, the term loan what we have had 154 crores as at March, and that term loan has now reduced to 140 crores. So it is close to around 14 crores overall decrease in terms of term loans. In terms of borrowings, we were at net, if you see the borrowings including the VPDs, we were at 366 crores. Now it is 349 crores. So in terms of borrowings also there has been a decrease, but not as massive as we would have expected during this. So overall our debt has come down from 520 crores to 490 crores. This is the total overall debt numbers.
Thank you. Regarding the capex, what I would want to state is that, as I said, we are finalizing our budget. We will have numbers to share soon on that. But as of right now, we are going to continue with 75 crores. And right now, as I mentioned on the call, in Q3 we generated about 16 crores of cash before tax. So we expect that to climb substantially in this quarter. So we don't anticipate, we will not be raising additional levels of debt to finance these things. So as much as possible, we are going to, vast majority of our capex will be through our internal accruals. So accordingly, the use of our cash that we generate will be as a feedback loop to ensure that we increase our cash generation capacity, which means revenue generating asset, which means revenue. So the 75 crores will be funded through internal, and we have funded that through internal itself in this financial year. So yeah, next year's plan, we'll come back to you.
Sure. Just moving back to question Q, if you can give cash balance on balance sheet, and that's from my side.
Yeah, 1 second. Total cash we have close to around 22 crores in terms of the amount that we have, and the investments in mutual fund are another close to around 18 crores. So total 38 crores is what we have as at December.
Got it. Thank you, sir.
Thank you. The next question is from the line of Venudhar G, an individual investor. Please go ahead.
Good morning, Aditya sir.
Good morning, Venudhar G. Please go ahead, sir.
Yeah, I am new investor. So if I ask any relevant question, please.
Not at all, sir. Please. We are glad to have you. Welcome to the Pennar family. Any questions here, please, we are glad to answer.
Yeah, I have 4 or 5 questions. First question is, what is the status of land sale in Patancheru? And have you thought about going for development of land instead of outright sale? That is first question. And second question is, any specific reasons for the resignation of Vishal Sood and Mr. P.V. Rao?
Okay.
And third question is, it's like you have said that regarding the divestment of OneWorks BM Technologies, you have mentioned in this call itself that you have taken all the contacts and all the business related things to Pennar Industries, and you are simply divesting. But in the unaudited financial reports, it was mentioned that board has approved you and executive director K. Lavanya Kumar to identify, solicit, deal, negotiate, and finalize in the best interest of the company while divesting the company. That OneWorks BIM Technologies. So does it going to have any revenue impact on the Pennar Industries? And it's like one last question. Can we expect any dividend by the company any time in near future?
Okay, thank you for your questions, sir. The first question you had was on status of the land sale for Patancheru. The company is not in land development, so we will not get into land development. We are only going to be selling the land directly to an interested buyer. We have finalized a buyer and we have concluded an agreement with them. Since as we have some amount of long-term debt, there's a first charge on all the assets of the company. So there's a communication that's moved to the banker and the potential buyer. Once the banker is able to give the documents of charge removal or NOC, yeah. Once he gives the NOC, that transaction will complete. Once that is done, we will inform you once that is done. But it's not ball is in their court, and I'm told it should be imminent on the bank side. On the plus side, that capital gains has not been taken into any of our P&L accounts. So when that does come, that adds the value of that land to our P&L. But so far, right now, we have not taken it in, but it's imminent. Okay. Second question you had was regarding the resignation of Vishal Sood. Vishal has been a director who has been with us for many years. He is someone who's been integral to our growth plans, to our strategies, and the board was very thankful, and we are definitely wish that he could continue. But unfortunately, because of his other preoccupations, he cannot continue, as he has mentioned to us. But we continue to wish him well in all of his future activities, and there is no other reason for his resignation. There's nothing to be concerned about in that sense, as far as our opinion and knowledge is concerned. Okay. Regarding Mr. P.V. Rao, the Nomination and Remuneration Committee has not taken up his extension in the last board meeting. So his tenure expires on March 31st. What is to be done post that, after that, we can, once the board has cleared us to tell you, we can come to you. But right now, we have nothing to share on that. And Mr. P.V. Rao continues as the JMD until March 31st. The next thing is divestment of OneWorks. I mean, as I'd answered the question before, there will be no revenue going forward in that company. It's a wholly owned sub. There will be no revenue impact on Pennar Industries because of this divestment. The divestment, the board has authorized us to find through whatever process completely allow for the sale of this entity, because there's not going to be any revenue, there's not going to be any transactions or anything in there. Consequently, there will be zero impact to Pennar's P&L because of this divestment. Your last question was on the dividend policy of the company. We are in the process of drafting one. As you're aware, I think in the last 1 year, because of the pandemic and other reasons, our cash generation has for the first quarter and for the fourth quarter of the previous year was impacted. Consequently, we had to revise our policies. We had actually during when the lockdown was imposed, we were undertaking a buyback. We completed about 70% of the buyback, to my knowledge. I'll confirm those numbers. We believe that corporate actions of this nature are still available to us. We still have cash. We are now generating cash, and our cash generation capacity is growing quarter on quarter. So as we conclude this financial year, we will be able to come back to you with our corporate action policy, which includes dividends and buybacks. But we are quite eager to see what the opportunities in both of these options can be for the company. But as if what we assume is going to happen, what we are very confident is going to happen happens, and our cash generation continues, we will absolutely articulate the strategy very soon. Those are my answers. Anything further or?
Yeah, I have two more questions. Can I ask now, or I have to wait in the queue?
We go ahead, sir, since you're here already. Please.
Yeah. What is the status of Raebareli plant being developed by the company? And one more is, what are your ambitions as CEO of the company regarding the future of the company?
Okay. So, Raebareli is land we acquired to build a plant for railways business, catering specifically to MCF, but also for Chittaranjan and others. Those opportunities still exist, but as I mentioned, right now there's a lot of volatility in terms of what our customers in the railways field, which include ICF, MCF, but also include customers such as GE and Bombardier, and also now MEDA, who are implementing a large plant. So as that picture gets clearer, we'll be able to finalize timelines. But what we have done is, because the offtake from railways has decreased by a lot, we have put this capex on hold. We have the land asset, we can execute at any point of time. A lot of the assets, machinery, that equipment that we had purchased before that, such as our 5-axis equipment, robotic equipment, is now being installed right now in Hyderabad. Once that market opens up again, we have a lot more clarity. We can absolutely hit execute and complete the railways project there. Now we also have land options there to implement a PEB project, like a North India PEB project, which has also been a project which has been very dear to us, close to our heart. Right now, as I've said, we will look at PEB addressable market being regained in the first quarter. At that point, we'll take a call. So we will have a lot more information on you on Raebareli in the first quarter of the next financial year, once the railway situation and the PEB situation clarifies. But whenever we choose to execute, we will be able to execute it quite quickly because we have the land and some of the equipment has already arrived as well. Lastly, I think you asked about, I hope I didn't misunderstand the question. I think you asked about my ambitions.
Yes, CEO of the company and future of the company.
Yes, sir. So my ambitions are to ensure that Pennar grows sustainably in the engineering fields and ensures that it acts as a problem solver for our customers in the various engineering fields, whether they be in automotive, railways, energy, infrastructure, such as building guardrails, or in the environment business. I think the basic model of the company, as far as I am concerned, is to have revenue generating assets, to use those revenue generating assets to generate a profit and use that profit to grow the revenue generating assets. That sets up a feedback loop where over time the revenue of the company will increase. We've been following this path for about 3 to 4 years, and we have grown from an 800 crore company since when I had started to now, where even at the pandemic time we'll be now at a run rate basis, we are at close to 200 crores per month, which means that we would be at 2,400 crores in terms of gross sales. We'll continue on this path, sir. My ambition is to ensure that during my tenure at Pennar, I leave Pennar a much stronger company from a technical capability point of view and a financial standpoint, and as per the company's market cap than when I left it. I think it's important that we achieve all of those, and on behalf of the entire management team, it's not just me, on behalf of the entire management team, we have a tremendous amount of management depth in Pennar. Otherwise, we wouldn't have recovered as quickly as we had in these sectors. I'm quite confident that the future is better. Our best days are ahead of us, and I'm certain that we will grow from strength to strength in the next few years.
Okay. Thank you, sir.
Thank you. The next question is from the line of Karthikeyan VK from Suyash Advisors. Please go ahead.
Yeah. Good afternoon, Aditya. Couple of things. One, can you talk a bit about the thinking behind having an operating business in USA? I'm referring to the PEBS US business. How does that tie in with your India business? How does that help? Is there a synergy there, either from that side to here or this side to there? Some thoughts on that, and also the economics of that business. I understand you spoke about 4x asset turn, but can you also talk about overall economics of that piece?
Okay. So let me preface this by saying a lot of what I'm about to say next is aspirational. I can only commit to you when I'm 100% sure, but I can explain to you why there are substantial advantages to us having the US plant and what the broad level thinking is behind that, not just the financial ratios, which tend to be conservative in nature. And I'll talk about the 4x asset flip and what we actually expect it to be. But I would like, as I said, to preface this by saying what I'm going to say next is aspirational as opposed to commitment. Strong aspirational, not castles in the sky, but definitely realistic targets, but not commitments right now. Now, as the synergies for a US plant effectively mean that when we manufacture metal buildings in the US, it opens up a massive addressable market for us. By the very nature, metal buildings are supposed to be executed and completed in a very short period of time. As opposed to conventional construction, the design process, the manufacturing, and the project management process are all owned by one entity, as opposed to an architect, PMC, labor, cement, steel, tremendous work at site. So that provides certain opportunities from a supply chain efficiency and a timeline point of view. So if we have a plant in the US, that opens up a much more massive market for metal buildings, which we know very, very well for us. Now, as regards the design process itself, which is where the metal buildings in the US starts, we have perhaps one of the largest structural engineering teams in the country here in Hyderabad and also in Vizag. And we have designed many US buildings. Accordingly, we have very strong capabilities in designing buildings which are compliant with US codes and aligned to US approval processes, US certification, including IAS, which is the International Accreditation Service, which is required for all manufacturing activity, and also on the Canada side and others. Since we have these capabilities and we have possessed them for a long time, we made maybe hundreds of buildings would have been designed and detailed by us and engineered by us for the US. The combination of that plus manufacturing in the US is actually a very strong layer. The one other thing which we believe where Pennar, we are in a unique position and it would be very, very difficult for any of our competitors to achieve is that if we can, for longer jobs, larger jobs, and I would direct you at this time that the US metal buildings market is well over $5 billion as compared to $700 to $800 million in India. So it's like 8 or 9 times India's size. So in that market, if we get large jobs, we can even manufacture in India and send there. Now in India, we sell metal buildings at 70,000-80,000 rupees per ton. Sometimes it goes to 1 lakh rupees per ton. And in the US, they're sold at 1.6 lakhs per ton. So that is obviously a 60% increase after accounting for transportation costs, after accounting for all of that. There's a massive increase that is possible. But of course, the supply chain advantage, it's tenured a little bit there because we're adding a month. My hope is that, and I will update you further on this, we're taking our first pilot projects for India manufacturing US supply up. We're taking that up in this month. Our hope is that we are able to design in India, get orders in the US, and manufacture in both US and India so that the critical parts which are supply chain efficient, which need to be supply chain efficient sent in the US, and if we can do the manufacturing of the remaining parts in India, I believe we are in a place where we can reap tremendous benefits from a margin point of view and also in a revenue growth point of view. So that is the logic behind doing that. The other reason is there's no reason why this has to be restricted only to metal buildings. This applies equally well to solar MMS. It applies equally well to a lot of the assembly that we do for our environment business. Skids can be manufactured in India as opposed to US. The US is a massive market. We want to be present there. Setting up this manufacturing plant, setting up the sales offices which you already have, setting up a warehouse which you already have, and a corporate infrastructure team of well-trained professionals with massive experience in this is a long-term strategy for us to replicate what we're doing in India in the US. And that can only mean good things from a revenue and profit point of view. However, there's a lot of work ahead of us in this, and right now would be premature for me to commit, which is why I'm saying these are all aspirational. We will commit to you quarter on quarter what we're going to do, but this is a dream. Our dreams can't be small, right? So it's a dream, but we really believe it's a realistic dream. Sorry, go ahead.
I'm sorry. Just to interject, in terms of your right to win, you are currently saying that at least on the business development side, it is because you have a team of experienced people.
Yes. Kimball is our CEO in the US. Eric is our the director for Pennar Global. We have We have several people who have 20, 22 years of experience on our team, not just the sales side, even on the operations side, even on the logistics side, even on the, frankly, on the oversight engineering. While the work may happen here, the customer intact as far as engineering, we have an engineering team. We have a great team. Otherwise, difficult to generate 5 million in sales immediately after they joined, also at good margins, and to start operations. We've already started actually revenue, and in February month we have started revenue in the US. So for these metal buildings as well. So give us some time on that, sir. We are very, very optimistic. We are seeing good things happen. Traction is good. And if it works the way it's supposed to work, then we have good things. But again, aspirational right now. Please force a commitment out of me on this over the next few quarters, and we will make sure whatever we commit to you, we achieve. The last question you had was asset flip. We are committing 4x, but there's no reason why it should not be in line with our regular flips in India, which are closer to 6x, 7x during normal periods of time before, pandemic.
And any comments on profitability or economics, either way?
All of our revenue streams in the US, whether they be for CDW tube supply, our hydraulic supply, and our engineering services are all at much higher margins than what we have in the US. In some cases, they are easily 1,500 basis points or 2,000 basis points more than what we get in India. But all of these are small revenue streams right now. So for them to start really impacting Pennar, they have to scale up, which means we have a lot of hard work ahead of us, and obviously there's uncertainty in markets for everything. So we're not committing any of this. This is our hope, and we'll work hard to achieve our hopes.
Super. Just one clarification on a couple of data points you mentioned. In the tubes division, you said that of the 20 crore per month run rate currently, 2/3 comes from ERW and 1/3 comes from CDW, and 1/3 of the CDW division currently is exported.
That's correct, sir.
Right. And what would have been the peak mix for you? So I'm just looking at what you could go back to.
Our CDW never exceeded 40%. That's because we had 40. Yeah, and it was around the 40% range for CDW. But obviously, we've been steadily increasing capacity. We'll continue to increase the capacity. We have the capacity to do about 1,500 tons of CDW, depending on the product profile. Our main competitor, TI, who we have a lot of respect for, obviously they have a broader product profile than we do, but they do 6,000, 7,000, 8,000 tons. I think at their peak they did even 10,000 tons. So the market exists, and we can keep deploying capital and growing, which we will do. But as of the current market circumstances, once auto has recovered a little more, once exports have recovered a little more, we will absolutely ensure that this business goes up. So tubes has tremendous potential.
Thank you. I would request Mr. Karthikeyan VK to rejoin the queue. Request participants to limit your question to one at a time. The next question is from the line of Puneet Jain, an individual investor. Please go ahead.
Hello, sir. Good afternoon. I'm a shareholder for this company since 2016, and since then I've not even touched any of the shares. Just because you are so ambitious and gaining a lot of experience in this business, I just want to add a few points. But as
Sorry, we lost this line. So we'll take the next question, which is from the line of Dilip Sahu, an individual investor. Please go ahead.
Yeah, thanks for the follow-up. Just a couple of data points you have spoken, and I'm just trying to clarify them. What you said is that by Q4 next year, we will achieve around 4 times asset turn for the US investment. Our working capital will come down from 100 cash to cash will come down from 100 to 75. Our interest rate will come down from 5% to 3%, and you will achieve in this quarter, just correct me if I'm wrong, this quarter, Q4, the profitability and revenue of last year Q3. Are these correct numbers?
Let me just verify one by one that you have the thing. In Q4, we will achieve last year Q3, which is FY20 Q3's PBT, cash PAT and PAT. Yes, we are definitely saying that.
Interest outflow will be 5% to 3%. I'm just taking next year by end, just this is my supposition. By say FY22 Q4, interest rate I can take as 3% compared to 5% of current year as for percentage of sales.
The interest cost of 3% as opposed to 5%, we have not said Q4, sir. We have said it will come to 3 to 3.5% over the next couple of quarters. So
I'm saying Q4 of next year, I know FY22.
Yeah. So obviously, yes, the answer is yes.
And our cash to cash will reduce from 100 days to 75 days.
That is correct.
And we will have an asset turn of four times. It's not as you rightly said. It's not we are holding on to you, but your aspiration 4 times at a much higher profit as far as our US investment is concerned. So these are the.
I just want to clarify that. So the 4 times asset turn refers to yearly revenue, sir. So when we say in the quarter we will achieve, that means we will achieve the run rate, sustainable run rate.
Understood. Asset turns are always NM. Okay, fine. Thank you very much. These are my clarifications. I have just only one, kind of doubt. If you have to reduce your interest outflow from 5% to 3%, because your working capital, even if it reduces from 75 to 75 days, you will grow by 25% is an assumption. So you won't release any working capital that way, and you are going to invest 75 crores this year, 75 crores assuming next year, 150 crores of investment. And there could be a free, cash flow from operation of around 150 crores because this year is not a great cash flow from operation. So how will this 5% to 3% come? Because this will impact your profitability after tax by some 100-200% the next year.
So let me, in everything that you said, only one thing, sir. The 75 crore investment is not from now. The vast majority of it has already happened. So it won't be 150. It will be substantially less than that. Entirely, it has not gone out, but it won't be 150 crore cash outflow. As to how we will get from 5% to let me say 3 to 3.5% is what we had said. So let me talk about that. Really, a lot of it is on how our revenue grows. We stock a certain amount of standard inventory, which we have, frankly, for the last 8-9 months as well. So as we scale up, our inventory days will go down, our revenue days will go down because the differential revenue that we add will be at a more efficient time. So how we will achieve 3 to 5% in terms of interest cost is if, let us say, we increase our current revenue base by, let us say, 25%. So that means that on a monthly basis, I am increasing by close to about 50 crores revenue. If cash to cash remains on 75 days, then I'm actually adding about little over 2.5%, not even 3.5%. But if we take 3.5% as the interest, that actually allows me to even sustain my operating cycle, which is there right now at 100 days, and still achieve that for the differential amount about 3%. However, for us to get from 5 to 3, the increase in revenue will have to be at a substantially less than 3% so that the average comes down to 3.5%. That we are definitely seeing through liquidation of our old AR, liquidation of our current inventory, ramp up of our current revenue, and new revenue being added. The combination of all of those for us will indicate that we will have around 3.5% itself in terms of our interest cost. Accounts payable also can go up. We have not talked about that much, but in the last few months, JSW and Tata have tightened their ship. Raw material prices have increased by 70%. We don't believe this kind of growth is sustainable. We believe that at some point it will correct as well. It has to, because the last time this happened was 10 years ago, and we're not strangers to volatility in steel market. But our mapping for sustainable revenue indicates that if we were to achieve this 25% growth in revenue, which we're very confident of doing, then all of the numbers fall into place from a 3.5% point of view. And PBT percentage also rises dramatically. So yes, in effect, our profit would increase a lot. Right now, our PBT is only 3.4 crores. That looks low. Our cash profit also is only 16 crores, which is cash PBT, PAT plus PBT plus depreciation. If we add 25 crores in revenue and we add that it's a per month number, sir. If we add 25 crores in revenue, if we add 30 crores in revenue per for the year, for a month, per month, if we were to add that, or even that, then that immediately means that all of our differential contribution and everything we're adding is at high contribution. So 12-13% of that comes into it. So a monthly cash PBT will increase by 5 crores, 6 crores. So I think our projections make sense, and you will see dramatic improvements in our bottom line as we increase revenue. So, and the 3 to 3.5%, quite frankly, has to happen, sir. We cannot. These businesses are not sustainable at 5, 6, 7% interest costs, frankly speaking. So we have to get that number down through a combination of scale and through liquidating anything which is slow moving.
Thank you. We'll take one last question, which is from the line of Vineet Jain, an individual investor. Please go ahead.
Yeah, excuse me. The call got disconnected from my side. So my point was, since 4.5 years, I'm an investor to this company, and just that you are so ambitious, I'm also stick to this company. So since 2017, 18, 19, 20, I have met a couple of people. I mean, over the call also. I've spoken to Krishna Prasad sir. I've spoken to Mirza. I've spoken to Bhakkar sir, Shrikant Bhakkar sir. I mean, and then last year in the month of November or October, I think. Yeah, November. I have also mailed to you personally on the email ID of Aditya@Pennar in India.com. Sorry, so I have not received the response over that. And the biggest point I want to make here is, I don't understand. Everyone is speaking about the top line, bottom line, etc., etc. No one is speaking about the barriers to entry. I'm quite surprised. Why is it so? Because in this business, whatever fields we are into, we have dominant players, and being a fully platformed company, we have all the things which can be done within the company. And I don't believe if there is any single company in India which has that particular platform. Still, we are lagging behind. So I just wanted to understand what is the reason behind, and also I just want to spend some time with the management, with you all personally, so that I can understand what is the problem inside. Thank you, sir.
Viniji, firstly, thank you. In terms of what you had said, I'll break it up into 3 pieces. One is your communication with us and the email that was sent to me. On that, there can be no excuse. I will make sure that I look into it. I mean, I have 2 or 3 official email addresses. It is not a good excuse, but I will make sure that I communicate to you an email address which I use all the time. And if you can send your communications to me on that, I can assure you a prompt response. Regarding the barriers to entry, I think entry barriers for any business are critical if you want to maintain long-term margins in that vertical. What we try to achieve is 2 things. Entry barriers in the current field can only come in through people knowledge or through capex size. There's really no other thing unless you're investing a tremendous amount in R&D and technology. Entry barriers of the nature you're talking about is in our view difficult to achieve. So we try to achieve a sort of entry barrier in a different way. We try to link all of our businesses together, and we try to build a core competency. What is our core competency? Our competency, our capability is basically in the field of metal processing technologies, metal engineering technologies. So whether that be roll forming, whether that be precision fabrication, whether that be fine blanking, whether that be hot stamping, which you have just added, and also our LPS and HPS capabilities. These are all capabilities that we add which form part of one overall set. That gives us the ability to differentiate ourselves from our competitors. So they may not be entry barriers because capital has become far more easily accessible. Quite frankly, in some of our businesses where it looks on paper like someone can spend 50 lakhs and start competing with us. But actually that is not so. Now, if we do have this capability set, why are we not seeing it in margins? I think what has happened over the past few years is that there has been greater and greater commodification of some of our business lines. We are now looking at rationalizing those business lines so we don't give them more capital. But over time, we believe that this gathering of our capabilities, packaging them in separate ways, and focusing on relentless focus on metal processing technology, metal engineering technologies, design technology, manufacturing, project management technology, as it relates to that, will see us dividends. The vast majority of our revenue streams spring from this core capability. We will try to get the call today may be inadequate to give you a complete picture of this, and also I think the questions you asked are quite good. You're welcome to join us. We would love the chance to do it. What I will request is, if you can give me your email address, I will have sent to that. You sent your address. Okay. So my email address has been sent to you. If you can forward in your dates of when you would want to make the visit, we will make it open to all of our investors as well. And whoever want to come in, we would invite them to join and to discuss with and all of our management will be made accessible to you to discuss specifics about our capabilities and on the long-term viability of our revenue streams, specifically barriers to entry. We can have a good discussion on that.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I now hand the conference over to Mr. Vikram Suryavanshi for closing comments.
Okay. We thank the management of Pennar Industries Limited for giving us an opportunity to host the call and taking time out for the interaction with the investor. Sir, do you have any closing comment or?
No, thank you for hosting this, Vikramji, and to Philip Capital. We are good to go. Thank you for the questions, and we'll continue our outreach to our investors and make sure that we improve as well. Nothing further from me, sir.
Thank you. On behalf of Philip Capital India Private Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect your line.